Good afternoon to our webinar today. My name is Sean van den Berg. I'm an investment specialist here at PSG Wealth. I'm also the head of client education. Welcome to our webinar on a Friday afternoon. As you can see there, the topic is Introduction to Risk Management. As you guys did now with doing the sound check, any questions you have, please type in the question box. Hopefully I'll be able to answer your questions within the presentation, but there will be a slot for questions at the end of the presentation. That's number one. And number two, this presentation, as well as the PDF of the presentation, will be emailed to you people this afternoon. So don't worry about the recording. The recording will be sent out to you. Okay, so let's get started. As you can see, as I said, the topic is Introduction to Risk Management. Just understand, when we say risk management, it applies to being an investor and also as being a trader. Now, when I did this workshop here in Joburg 2 days ago, Wednesday night, I found that most of the people in the audience were traders. So this presentation we're touching on risk management for both, but obviously most of the presentation will be aimed at the trader. So I'll be discussing technicals again and discussing some trading strategies, but within the context of risk management. I hope that makes sense to you guys. Okay, so let's get started. On the next slide, you'll see there's two kinds of risk. So we talk about risk. Remember, the whole thing about risk is the higher the potential return, the higher the potential risk. And there's two kinds of risk. So first of all, we talk about unsystematic risk. This is a risk to the individual share or sector that you're involved in. Now, I think just to make it easy to understand, I'm using the example of the avian flu going around, affecting obviously all the chickens. And the first one that would come to mind would be Rainbow Chickens, other companies like Astral and Sovereign Foods and things like that. It's a disease that affects these birds that have to be destroyed, and obviously that's your stock and your business. So remember, it's a risk associated to a particular share. Okay. So how do you, as an investor, manage that kind of risk? You want to spread your risk around. So we talk about diversification. So another word for diversification, I use the word spread, because I will talk about the three S's just now: the spreads, the structure, and also the stop loss. So the structure would be the quality of shares you have in your portfolio. We talk about the top 40 large cap shares. We talk about the next 60 companies in there. After the top 40 would be the mid caps. So those combined we call as the top 100 by market cap. It's the size of the companies. Those are the big companies, been around for a long time. Anything outside of the top 100 we classify as small caps. So it's the quality, that's what I'm referring to. So it's a lot of the novice investors would want to get involved in the penny stocks, the shares that are a few cents, with the idea that the hope that the share goes from a few cents to maybe a rand or so, to doubling the money in a very short period of time. But I always say there's reasons why those shares are trading at those prices, because the market has pushed them down. So there's the difference between a penny stock and a small cap stock as a quality stock. So when I refer to structure as a quality, and when we're talking about quality, we're looking at sustainability. We look at the margin of safety. And 2-3 weeks ago, we spoke about fundamentals, and we spoke about the quality, certain financial ratios you'd use to help you sift away from the riskier shares to look at the better quality stocks. Okay, so that's what I mean by unsystematic risk. And as an investor, those are two main ways of managing risk. Then we talk about systematic risk. This is the risk that the whole stock market can fall. Okay. And this is where you have to look at the market, where the market is right now. The JC All Share, we're at all-time highs on the daily basis. We're making new highs, same as the S&P 500, same as the Dow Jones. So obviously, when you're at the top of the cycle, yes, we are making new highs, but how long will that be sustainable? We're looking at more close on a 10-year bull market. There has to be a stage where there'll be where the investors as a group will say the market is expensive. Or there's not value in the market, and start taking profits. And obviously we'll have a pullback and things like that. But that's, our last stock market crash. We don't really talk about stock market crashes anymore. The new politically correct term is healthy corrections. So we talk about a 10% pullback being a healthy correction. Anything more than that, I'd say 20% is a stock market crash. Back in 2008, we had a 45% correction. That's a healthy correction. It took the market 2 years to recover. So how do you manage as an investor? How would you manage that? This would you apply a stop loss. Now, I sort of caution you guys here. As an investor, your strategy should be a buy and hold investor, and you want to buy into good quality stocks for the long term. If you're going to apply a stop loss and the market drops 10%, now you're selling, you might be more actively involved in buying and selling. Now you're not really an investor anymore. Remember also your view is more 3 years plus. So I have a question mark when it comes to stop loss in a investment portfolio. We're talking about it again more just now. So ideally, you want to use a stop loss more in a trading environment and using diversification and structure within an investment environment. Another way of obviously managing risk. Remember, in this context, we're talking about paper assets being involved either in shares or directly in shares, or indirectly through unit trusts or all of the other wealth products. But ultimately involved in the share market, even through exchange traded funds. So you're in one asset class. That's the point I'm trying to make. So one way of also managing risk is through asset allocation. So you might want to allocate some of your investment funds to cash and money market related instruments, be it bonds and things like that. And we talk about paper assets, as I say, this is more the shares and unit trusts. You might go one step further, diversify some of your investment funds into physical property. In this sense, I'm talking about rental property. You might go so far as commercial property. And then obviously the fourth category would be looking at investing into physical commodities, physically holding Kruger Rands, or gold or things like that. But that's where we talk about asset allocation. So in this context today, we're only talking about one asset class being paper assets and shares. So this is going one step further now. Managing that risk is talking about structure and diversification and using a stop loss mainly from a trading point of view. And also as a trader, even as a long-term investor, you might want to use more advanced techniques called hedging. So you got a long-term share portfolio. You anticipate the market to have this healthy correction soon. So you want to hedge yourself using single stock futures or CFDs as ways to minimize that risk. So what you lose on the equity portfolio, make up on the derivatives. So yes, you got a capital loss there, but you're not having any capital gains or not triggering any capital gains, because remember, you're not going to be selling your shares. And this helps you to lock in that profit by using derivatives. I hope that makes sense. Saying that, yes, this is supposed to be a basic trading course. I want to highlight hedging, and I want to bring into the idea that we are introducing more advanced workshops next year and webinars. So hopefully some of you guys might be interested in that. Yeah, so I'm just planting it out there or placing it out there. Okay, so the idea here, when we talk about portfolio management, remember, if you look at your investment philosophy, Warren Buffett has got two rules. Warren Buffett, #1 investor in the world, value investor, he says, rule number 1, never lose money. Rule number 2, never forget rule number 1. And that should be your #1 rule also when it comes to as investor. So preserving capital is your #1 rule. So the idea here is that winning investments should be maintained in your portfolio and losing investments must not be held. So that's #1. And #2, your second rule would be objective. It's easy to be emotional about the market and emotional about the shares in your portfolio, but the idea is to consider, this is just for demo purposes, not a suggestion to rush out and buy these shares in this little portfolio. Some of my colleagues refer to this as my snooker table, but just to get the idea across. So don't use any of these shares as a tip. Remember, that's my disclaimer. The idea is just to get the idea across. So you want to consider diversifying your portfolio along the lines of sectors, first of all, between 3 and 5 different sectors. So remember, you've got 3 different industries. Broadly speaking, industry, we talk about financial shares, industrial shares, and then mining and resources. And within those industries, you chunk down now to the individual sectors within that financial sector, for example. So you might be looking at banks. And in this scenario, I'm just using an example. As I said, I like Standard Bank and I like Liberty. I'm using an example again. It could have been any other financial share. But the idea was to diversify my portfolio along the lines of sectors. Okay, so if I had 100,000 Rand and my goal was to build a portfolio of roughly between 8 and 12 different shares in my portfolio, in this situation, Again, as example, let's say I want to allocate 50% of my funds, most of my funds, to good quality large cap stocks. So these corner stocks are the top 40 stocks. So there's my Standard Banks, my MTN, Sasol, and Tiger Brands. MTN, obviously, I like the MTN, or even Vodacom. It's a company that at that point in time would be growing its market share by growing more subscribers into Nigeria, whatever the case might be. The reason why I like MTN and Vodacom is it's residual. They start because most of the people have contracts and debit orders, whatever the case might be. They start a month with money in the bank account. That's the reason why, for example, why I would like to have those shares in my portfolio. Sasol, I have it as a resource stock. And it's not so much the exposure to the oil, it's more the IP I like. And that kind of stuff, but that's my resource stock. Just having exposure to that is my Rand hedge stock. Yes, that's also a Rand hedge stock, and so is that. Take advantage of any weakness in the Rand because these guys have operations offshore. And Tiger Brands would be a food company, defensive company. Anything happens with the economy, people still have to eat. Okay, but the idea is that I'm structuring the portfolios along the lines of sectors. So that's my financial shares. Those will be industrials. These will be resources, and again some industrials. So I'm allocating at least 50%, so it'll be 12.5% to each of these pillar companies. I'm allocating less funds, 40%, to 8 different companies here in my called by second tier companies. So I'm allocating roughly about 5,000 Rand or 5% to each of these companies, allocating less funds to the more riskier, if I were to put it that way, shares. And then as a strategy, you might want to decide to keep maybe 10% of money in cash. The reason for that is, and the main idea there is opportunity. If you're fully invested and you've got no cash available and opportunity comes along, you're going to be forced to sell one of your shares in your portfolio for the wrong reasons. Okay, so the idea is that I like to keep some money in cash. It also depends where the market is. You might have moved more into cash as we get into a more mature stock market, but also remember these companies might be paying dividends, and you'll be accumulating dividend all the time. So the idea is that you'll be adding to all these shares all the time. We're talking about buying in the dips just now. So you're buying in where the share pulls back on weakness, you add to those shares. And this is how you build a long-term share portfolio. But remember, the idea of portfolio management, I want to stress here, is the structure and the spread. So I don't bring all my eggs in one basket, bring all my shares in gold stocks or bring all my shares in banks, etc. I'm spreading the risk. So when the Rand gets stronger, my financial shares go up. When the Rand gets weaker, my Rand hedges go up. And that's how you start building a balanced portfolio. So I like the idea of a balanced portfolio. Ideally, I'm a value investor. So undervalued stocks, you might have some element of shares in there that will be the growth stocks, be it the Curos or the Capitex that are growing up more than 15%. But also you want to be aiming for a portfolio that's growing high on dividends, paying out at least 5%. So this is how you structure your portfolio. Okay, I hope that makes sense to you guys. Remember again, my disclaimer here, this is just for education purposes. The idea is to consider the upside and the downside potential of all these shares when you're looking at your watch list. Remember the last 2 weeks we spoke about using fundamentals to scan the market, using technicals to scan the market, or using technicals to get your timing right with the shares that you decide are undervalued, profitable, with manageable financial risk. So you consider the risk and upside potential with all these shares. So the idea is to have a reasonable watch list of shares, as I always say, potential watch list of winners, and then you want to track what's happening on the market, the indices, the main indices, what's happening in the top 40, what's happening in the JSE All Share. If the whole market's going up, it means that most industries or most sectors are going up. Most sectors are going up, most shares are going up. And that's also always, you always have to keep in consideration with being a long-term investor. Okay. So when it comes to a long-term or a share portfolio, the idea here is also to review your portfolio quite regularly. The idea is to systematically review your portfolio. This might be done once a week, once a month. It's up to you how much time you got. But each review, you should ask yourself a series of questions. And obviously the answers to which, would be supported by facts. Remember, you can get emotional and opinions might shift you, but you need facts. And those questions would include, does the distribution or the spread of the shares or sectors in my portfolio need to be adjusted? You should never have more than 20% of your portfolio exposed to one stock, because that's risk. So also, you don't be too much exposed to one particular sector. I was talking to a friend of mine this morning. He's heavily involved in property shares in his portfolio. So if the whole sector is coming down, that means your whole portfolio is coming down. So those are the kind of risks you have to be aware of. Does the distribution within my portfolio still tie with my investment strategy? Remember, my investment strategy is, first of all, is buy and hold. Secondly, I want to buy into quality, long-term, undervalued stocks with element maybe of some growth stocks and things like that. But if the share, if I bought Sasol's with the idea of being intellectual property, yes, they have exposure to oil. The next month, Sasol changes the nature of their business to selling cell phones. Uh, my original decision for buying a share might change, and I might decide, okay, let me sell the share. But you need to have reasons for selling a long-term portfolio. When would I sell? I'd sell when the share, my original decision has changed. I'll sell when it becomes overvalued on the PEG ratio or valuation on that method. And that's the only time in the long-term portfolio I personally would use a 20% stop loss. Because remember, it might go up a bit higher. It will come back a bit. If it pulls back 20%, then I'm out. But still, I'll be riding it out. And then obviously the other scenario is where future prospects might be changing. I remember there was one stage where Sasol's, they made a trading update and they said the earnings would be down 40%, but it was a lot on the back of the rand strengthening. So I knew it was a once off. So those kind of things you have to be aware of also. Does my investment strategy change? No. And then are the performance in line with my expectations? If your share is not going anywhere, you need to start looking at your fundamental reason for buying the share again. And then dig a bit deeper. There might be a better opportunity somewhere else. How does the latest information I have alter my expectations? So when the trading update comes out or the financials come out, does it change my portfolio, my assessment of the shares in my portfolio? And lastly, is any action required? If all is well, leave well alone. You don't need to sell the share to make a profit. Remember, you've got a paper profit. As long as the portfolio is growing, your capital is growing, and in the meantime, you're getting income from your dividends. Okay, so I hope that helps you also. And then let's talk about stop loss. As an investor, some of you might decide, okay, let me use a stop loss. From an equity point of view, on our trading platform, we have a facility called a trailing stop loss. Now, I'll explain the thinking behind this, but we'll go into more detail. I'll show you how to place this on the market. So a stop loss, the first question you need to ask yourself, how much am I prepared to lose? So let's say you decide a 10% stop loss, and you decided to buy the share 10 Rand, 10% of 10 Rand is 1 Rand. You're going to value the share down to 9 Rand. So the idea here is that you're eliminating human emotion. The biggest enemy on the share market is human emotion. Number one, greed, and the other side is fear. So in this scenario, instead of valuing the share at 10 Rand at the price you bought it at, you're going to value it at your stop loss level. So the value at 9 Rand. If the price drops to 9 Rand, what you're going to do? You're going to sell. Why? Because your original decision was wrong in its timing. Now, more money is lost by investors who fail to sell at the correct time than is lost by investors who buy at the wrong time. Okay, so people, the market pulls back 10%, they pull their stop loss and it drops, say 50%. Now you have to make 100% to break even. So the stop loss there in this scenario is helping you to minimize your risk. It also tells you, as I said, your timing is wrong. But let's say the opposite occurs. The share price goes up to, say, 15 Rand. Your stop loss now trails or ratchets up. So at 15 Rand, your stop loss is still 10%, is 1 Rand 50. You're valuing the shares down to 13.50. Remember, to the price that you be prepared to sell at. If it drops to 13.50, you get out. Now, 3 Rand 50 over 10 Rand is 35%. And this can be 2-3 months. 35% annualized is more than 200%. You're doing pretty well. Okay, but obviously you're in this situation, you've sold out, and yeah, you must understand that there's costs involved and also might be tax involved. So there's income in that scenario. So the idea of, remember, the stop loss here is to set the limit where you're prepared to sell it. The share price goes to 20 Rand, 10% of 20 Rand is 10 Rand, is 2 Rand, you're valuing the shares at 18 Rand. So if it drops to your stop loss, as long as it stays above it, you ride the trend. So yeah, as I say, at the bottom of the cycle, we minimize our losses. Yeah, we're riding our profits in the top of the market. Obviously, you want to maximize your returns. So again, remember, it's your safety belt in the market. You've done your fundamentals, done your technicals, just in case that doesn't work. This is what's going to protect you. So it's up to you to decide if you want to have this in a long-term portfolio. I suggest rather use this in a trading equity portfolio. If you're going to be buying and selling, then use it fine. You want to lock in your profits and let your profits run. Okay. This is how it works on our trading platform. So I suggest once you've bought the share, this is on referring to equities now. Once you've bought the share and you hold it in your portfolio, then you come back to new order again and you select price watch and stop order together. They have to act together. So you use a trailing stop loss in this scenario and you decide on 10%. Now I bought in this scenario PPC, 7.22 is the price I bought. 10% of that would be 72 cents. The stop loss would have, that scenario been at 6.50. My stop order, my bullet, always think of your price watch as a trigger. That's where if the price drops 10% and the trigger to go into the market now as a potential sell, I suggest you put your stop order, your bullet, slightly a bit lower at 6.45. Let's say, for example, I bought 1,000 shares. You want to sell all the shares, by the way. You can't be half pregnant. You want to sell 10%, 10 cents, or 10%. You want to sell all your shares. Your timing was wrong. But the idea here is set your stop loss slightly a bit lower. And you click on submit to go into the market now as a potential a sell order only when it gets triggered. So it will set in your price alert thing. Very important that you set up your email and set up your cell phone number to be alerted, because obviously you want to be taking action. By the way, if you just use a price watch without a stop order, you're going to get a little SMS and say, okay, the share's trading at this price at 6.50 Rand. Remember, then in that scenario, it's an instruction. The market does not act on instructions. The market only acts on orders. So that's why you need to have the two together. So think of them as a trigger and think of them as a bullet. Very important. I hope that helps you. Okay. So let's talk about risk management. I'm going to spend some time on this quickly. I know I'm talking, running out of time here, but go through this very quickly. Last week, we spoke about price action. I want to just hop on it again. So price action is the movement of the share's price, and that's where the risk comes in. If you're not managing the risk, you're going to be losing money. So your goal ultimately as a trader, as an investor, as I said, is to maximize your returns on the one side, but also minimize your risk. So if you understand price action, you understand the risk, and you can take advantage of that because it presents an opportunity. Okay, so price action, all it is the discipline of making all your trading decisions based on a stripped down share price, be it a candlestick and things like that. There's no other technical indicators other than maybe a moving average. I like to use a 200-day and a 50-day moving average, but we're looking at mainly price action. So the idea then is to look for support and resistance levels and also to help me establish the trend. That was price action is all about. So price charts reflect all the beliefs and actions of all the players in the market, be the institutions and private investors, even the computers, the black box algorithms, all that kind of stuff. So as the name would indicate, price action, it's all the action. So price action does not lie. So you as a fundamental analyst, we always say that from a technical point of view, everything we know about the fundamentals is reflecting, number one, in the share price, and number two is the volume, which is the number of shares traded. That's all you need to know, and that's how you can start analyzing the market. But saying that, nobody has a perfect system to predict the future. We're talking here about high probability trading. If I can bend the odds in my favor, that's how we make money in the market. There's no system that's fail safe. There's no system that's going to make you money every single time. There's risk involved all the time. It's managing at risk. So price action is just a perfect summary of the past, and obviously it is a form of technical analysis. Okay, so let's talk about trading gaps. Last week we spoke about using breakout trading, using chart patterns and that. So we just go one step further now. We talk about price action. So when the market closes at 5 o'clock, obviously that price is indicative of perceived value. It's not the true value of the share. It's what the group of investors will perceive the market to be, the share to be valued at that point in time. So when the market closes at agreed value at the end of the day, so yeah, we got an example of Mr. Price. This is what happened this week. The market closed. Okay, after hours, something happened. Actually, 5 o'clock in the morning, they released a SENS announcement, Stock Exchange News Service, and they released what they call a trade update. And they said that the earnings could be likely between 20 and 25% higher than those reported for the previous corresponding period. So 5 o'clock in the morning, this was released 4 hours before the market opened. If you saw that happening, you'd have thought, wow, this is better than expected relative to call it to Fashini's or to Woolies, whatever the case might be, and you would have taken advantage of it. But what happened is that the price, when the market opened, it opened with a big gap. And this is what we're going to talk about now. Take advantage of these, but understanding also why this is happening. So it's okay. So this happens is that the gap did not close. Okay, that was on the 7th, which was Tuesday. That was Wednesday, and Thursday was yesterday. You can still see we're making higher lows, but we haven't closed this gap. Okay, so that's what happens in that scenario. On that same day, by the way, or the day afterwards, as I say, the market does not close in Mr. Price's scenario, but this will be a target price because the previous resistance, the previous highs will now become a support level. So that there will be a target level to try and retest again. That's what I mean by this here. So this, I'll just take a screenshot. This is where the market opened on that day. That's where on the previous day, go back, that's where the market, that's the lowest it closed. Okay, or the lowest it traded, and that's where it closed for that day. So this was just a screenshot from the share info page. You can see that was the closing price. It opened lower, but eventually ended up higher for the day. That's where it closed up 1%. Okay, so that gap wasn't closed. Okay, so when we talk about gaps, we're not talking about this betting who's got the biggest gap in their teeth. Okay, in this scenario, we're talking about taking advantage of a price break on the chart. So it's gaps either when the market's falling or gap when the market's running. So it occurs where the share price makes a sharp move up or down without any trading in between. So this is what we're talking about. Take advantage of that. Why does it occur? As I mentioned just now, with obviously trade updates with Mr. Price, but also it's just regular buying and selling pressure. You either say it's panic selling or panic buying. Okay, but also a lot of times it would be a change in the analyst outlook. Analysts will put out a report there. They were anticipating better results from the company. Investors will read that and jump on the bandwagon to take advantage of it. So that's what creates the gaps. I hope that makes sense for you guys. So there's 4 kinds of gaps. You get the common gaps. They're not. They're not really anything to write home about. They're quite common. They happen a lot. So what it is, there's no major event that would precede the gap. So yeah, we've got a sideways consolidation or a range. We have this little gap up. So that's where the market would have closed. Okay, and the next day it opens up much higher. That's where it would have opened. It closed that day a bit lower. You can see intraday it's trying to push a bit lower, and also intraday pushed a bit higher. But there's a gap. Okay, but these things happen quite a lot. But the more common ones we're going to focus on is what we call breakaway gaps. Okay. So breakaway gaps, this signals the beginning of a new trend, especially a consolidation period. It breaks out above resistance, a ceiling, and it runs and it doesn't come back to fill that area. Okay, so that's the beginning of a new trend. You as a trader want to take advantage of that. Okay, we trade those and we talk about the runaway gaps. So runaway gaps usually happens, it's halfway up the trend. Another word for a runaway gap would be continuation gap, because it goes through a consolidation period and then continues on its original path. Another way of calling it would be called a measuring gap, because it measures halfway up the trend. So it's best described as a sudden increase in interest in the shares, as a panic buying on the back of an analyst report. The price just jumps up and it doesn't fill up that gap. So runaway gaps, just understand it's halfway through the trend. Exhaustion gaps happen at the end of a trend. So this is when the market's tired. So we have what they call a blow off, and in the market you can see that's where this will be filled. Okay, so the gap does get filled eventually. Runaway gaps and breakaway gaps, runaway gaps do not get filled, and that's my next point I wanted to make up here for you, is that they do not get filled very easily. Oops, go back here. And the idea is to understand when that happens. Once the gap is started to fill, it really stops. So you can see this gap is filled and it doesn't come back to retest it. It just runs away. Okay, so be careful that you identifying the right kind of gaps. But you can take advantage of it. But from a risk point of view, if I see this happen near the end of the market, I can anticipate we're going to have a pullback soon on profit taking. And this I can start managing my risk. Okay. So talking about that, let's talk about trading pullbacks. Okay, trading pullbacks. A pullback is a falling when the price falls back from its peak. You know, it's a brief reversal of the prevailing trend. It's just a temporary pause. As I say, it's call it a pause or a consolidation. But usually what I call another technical term would be called a retracement or consolidation. It does not change the underlying fundamental story. Just understand that a pullback and a reversal are two different things. We'll talk about a reversal now. So it's usually a pullback usually reflects a profit-taking opportunity. For example, when a company reports excellent results, the share price will jump up 50%. Might experience some pullback the next day by the short-term traders taking some profits. But the strong earnings report, we saw it now with Richmond, suggests that the share is still headed higher over the long term. Okay, so that is what we call a trade pullback, or a pullback rather. On the other side of the coin, we talk about reversals. Now, this involves more the change in the underlying fundamentals of the company. So this forces us as investors or the market to reevaluate the market, reevaluate the share. For example, a company reports disastrous earnings, and that will force you as an investor to go recalculate the company's, call it net asset value. And obviously, if you're re-rating the net asset value lower, the share price will be falling lower. Or you might look at broader, the downturn in demand for motor vehicles could lead to lower demand for steel, number one, and also lower demand for catalytic converters and ultimately platinum. And obviously, the long term, you'll see that the prices will be pulling back. People are moving away from those sectors. So I hope you guys understand the difference between a pullback and a reversal. So let's talk about swing highs and swing lows. Now, this is not a England a national anthem or anything like that, but it's a term used to refer to a peak high in the scenario when the share price has made a new high. So a swing high is performed when the high is greater than a given number of highs around it. So in that situation there, that high on that particular day is higher than the previous day's high, but also higher than the next day's high. Okay. And then we have a scenario where we have a series of consecutively higher swing highs. It would indicate that the price is in an uptrend. So you can see here we make a new high. So we break above our previous highs. And then that high is higher than that one and higher than that one. So that's a swing high low. I mean, it's a swing high number two. Market pulls back a bit and we go up high again. So you can see that one's higher than that one and higher than that one. So there's three consecutive highs. Remember, definition of a bull market is higher highs, higher lows. The definition of a bear market is lower highs and lower lows. Okay, so I just wanted to highlight that for you. And number two, obviously the opposite would be a definition of swing lows would be the troughs or the lows as such. Exactly the same thing applies. So your goal as an analyst is to understand this and understand where the risk is involved. The minute we break below the previous low, that's where confirmation that we're going to a downtrend. And you as a long-term investor need to decide, am I ideally diversified? This is when the whole market is falling, or do I need to start hedging myself? So that's where we talk about it, bring it back to risk management. So let's highlight quickly, and I know I'm talking a lot here, I've gone over time. Let's quickly talk about a swing trading strategy, because most of you would be into swing trading. We're going to talk about trading styles. Some of you might be day traders, you don't want to hold a position overnight, but most of you would be what we call swing traders, holding a position from 2 days up to 30 days. So this is what we call a swing trading strategy. 7 steps to help you get into it. So step number 1, you ask you what kind of market are we looking at. So yeah, I'm looking at Anglo, and I'm looking at the weekly chart going all the way back to 1995. So there are 4 stages in the market. Stage 1 would be the sideways stage at the bottom of the market. Stage 2 would be the bullish run up. Stage 3, the sideways market at the top of the market, and stage 4 would be the downtrend. Your goal as a long-term equity investor, long-term equity trader, or short-term equity trader would be establish the stage 2 or take advantage of an uptrend. So within that market stage, I want to see what stage were you on. We talk about Elliott waves. So yes, it is a bit more advanced technicals. Elliott wave came up with a theory that the market goes up in 5 waves and comes back in 3 waves. So we get wave 1, wave 2, wave 3, wave 4, and then obviously wave 5. Your goal as a technical analyst is to start and take advantage of the first pullback. Okay, after our stage one would be our wave one, and take advantage of that stage wave two there. And take advantage again when the market pulls back, and take advantage of wave five. So you want to trade wave two and trade wave five in an uptrend. Okay, so that's Elliott wave. By the way, with Elliott wave, anticipates that when the market pulls back, when the market's near the top of the market, when we pull back and we have this next rally, the change of trend will be that when this high is lower than that one. Remember, yeah, we're making higher highs. So that'll be a change in trend going from a bull market to a bear market. And when we pull back, we talk about the killer wave C. That's when the market pulls back big time. Okay, so that makes also sense to you. So your goal, remember, is to identify wave two and the beginning of wave five. And then step number three would be to look at trading trends. As I mentioned just now, in the uptrend, I want to confirm higher highs, higher lows, and in the downtrend, lower highs and lower lows. This is more for derivatives, single stock CFDs going short. We'll talk about that more in advanced courses next year. But as an equity trader, I want to confirm higher highs and higher lows. Okay. Step number four, we talk about the TAS, the Traders Action Zone. So yes, first of all, I'm using my 200-day moving average to confirm that we're in the long-term bull market, long-term trending market. And then I also want to take advantage when the market pulls back. In this scenario, I'm using a 10-day and a 30-day exponential moving average. So when the share price pulls back into this little zone, the difference between the two of them, that's where I want to get excited, because I want to take advantage of that little rally there, or that move there. When it pulls back, I want to take advantage of the next rise. Okay, so that's step four. Step five, I want to confirm a swing point low. So it makes like a V. So when we look at a candlestick chart, you can see that high is lower than that one and lower than that one. Makes that V. Same scenario here. That low is higher than that one. Lower than that one and lower than that one. And that's confirming point number five. So these are just building up and being the probabilities in my favor that the share is going to bounce up. And the last step I want to look now is what kind of chart are we looking at when we talk about candlestick patterns. So there's various chart patterns in these examples here. These are bullish candlestick patterns. So that's a hammer. Those are some dojis. Dojis are also highlighting indecision in the market. Again, there's also a bit of a doji. But these are all bullish patterns, and we're hammering the bottom of the market. The ideal situation would be incorporating now a bit of trend lines and things like that. I'll bring in a sideways market. That's my trend line. So step number 7 is where would I get in the market? Where is my stop loss? And things like that. And this is how we put a trade together on paper. So you can see as a sideways market, we break out above that resistance level. That will be my entry price in this scenario at 242 Rand 41 cents. Remember, the market is always in cents. And this is where we start bringing risk management in. Stop loss, very important. I'll use my previous low as my stop loss, but also incorporate my 30-day moving average into it. You can see it hugs it very closely. Previously touched there, didn't break here. So ideally, my stop loss will also, you can see it becomes very close here. My 30-day moving average can act as a stop loss. Okay, so that scenario, I've got a high probability. If it breaks through that, the shares will be trading direction. Because remember, there are buyers at this level. So in this scenario, that's my stop loss at 227.66 cents. The difference between the two of them, okay, gives me 13 Rand 77. So we're talking about risk reward ratio, and you should be in a scenario where you're always working on a minimum of risking 1 Rand to make 2 Rand. So I'm risking my stop loss is 13 Rand, but ideally I want to risk is 1 to 2. So my first target price would be the difference between the two of them here. So my 13 Rand 77 added to my entry price. That's my first target price. It exceeded that. Then it pulled back a bit. Okay, my ideal target price would be 1 to 2. So 269 Rand 75. I did eventually reach it, went way above it. So this is how you'd ride your price out. So my first stop loss would have been, my first target price would have been there. And as the price went up higher, and then came back, that's where I would have set up my next stop loss. I would remove my stop loss from there to my next swing low price, swing low trough. That's my next stop loss. So as long as it stays above that, I would have ridden the price out. So my target price in this scenario would have been exceeded. So this is how you put together a trading swing trading strategy, incorporating everything we're talking about now. So I hope that all makes sense from a risk management. It's very important to use stop loss. And you can see how we're using chart patterns and price action to help us bend the odds in our favor. I hope that made sense to you guys. So in conclusion, guys, remember we've been talking about various strategies. So remember, I want to just highlight for you the importance of just being disciplined, being patient, having a trading plan. Remember, understanding when am I getting in? You need to know these numbers before you place the trade. What's my entry price? What's my target price? What's my stop price? Those are the three prices you need to know. I always say you need to do the paperwork before you place the trade. And trade with the trend. The trend's your friend. It's a cliche on the market, but it's so true. Use protective stops always. Never, ever average down. Always cut your losses quickly. And obviously let your profits run. In uptrends, as we're talking about today, is buy in the dips and use optimum timing. Break out a bit of resistance with those chart patterns and things like that. And then, as I say, you would add to a necessary position, but in a much smaller scenario as the price runs, or alternatively, you raise your stop to the next swing low. Just understand, if you're using a risk reward ratio of 1 to 2, you only have to be right 33% of the time to break even to take to be right. So that's what we call high probability trading. Okay. So in summary, from an investment point of view, what is your investment objectives? Yes, you want to make money, but us ultimately have different accounts, different buckets, different investment objectives. Very important for that, and have different time horizons for that. We're talking about term as an investor in 3 years plus, and ideally a 3-year buy and hold strategy. Undervalued profitable quality stocks would be your philosophy, and managing risk along the lines of structure, be it large caps, small caps, or mid caps, but quality is important there. Diversified on a spread my risk between 3 and 5 different sectors and across 8 to 12 different shares. And again, as I said, in a long-term portfolio, I've got a question mark of using a stop loss. You'd rather use a diversification, an asset allocation to manage risk there. From a trading point of view, remember we're talking about trading the trend, we're talking about trading gaps, trading pullbacks and things like that. Those are just ways or means of managing risk, bending your odds in your favor. So this webinar, as I mentioned just now, will be sent out to you just now, the recording as well as the PDF. Please refer, you can click on these links here, refer to our online tutorials, developing investment strategy, and referring to portfolio management. Goes into more detail about risk management. So again, I hope you guys found it useful. Use technical software to help you with trading gaps and pullbacks. That's just a probability tool. Okay. So those of you in Cape Town, by the way, I'm coming down to do a workshop on Saturday, the 25th of November, from 8:30 till 12:30. It's a Saturday morning. There's no cost. We anticipate to have it at our Tiger Valley offices, but we'll still confirm it. But please go onto our website and go book your seats along. We've had quite a lot of interest from you guys in Cape Town. This is an opportunity for me to explain to you face to face all this, what we've been talking about for the last few webinars. Okay. Any questions you have, please do not hesitate to give us a call. Here's our number and there's our team's email address. But from my side, I hope you've enjoyed this. Let's see what kind of questions you guys have. I know I've gone over time. Okay, let me just quickly handle this quickly. What kind of questions you have? Because cool, Peter, pleasure. Okay, Quena, does the platform allow you to place pending orders? Yes, that's where you won't be using the trailing stop loss. You'll be using it buy and sell, and be using what they call market orders. You'd stipulate a price. If it goes above a certain price or below a certain price, it'll trigger it for you. So yes, the system allows you to do that. Clinton, pleasure, my bud. Okay, I hope you enjoyed it. Okay, here's a question from Colin. How does one locate shares that have gaps? Is there a filter one can use? Colin, if you've got a software program, like a charting program, most charting programs you can program, for example, the WEN, you can program for gaps. You can scan the market and it'll spit a list of stocks out for you. That's the only way you'll be able to pick it up is using a technical analysis charting program. I hope that answers your question, Colin. Okay, what other questions are there? Okay, Rudy says you would like to learn more about net profit. That is equal trading cost and CGT. So yes, really very important. And the suggestion always is to have two portfolios, one for trading, that'll be your income, and one for investing. That's for capital. So it's just easier from a tax point of view. You say to the receiver, this is my capital investment portfolio, buy and hold. If I buy, hold a share and I never sell it, I can never be taxed. Okay, because there's no profits to be taxed. They've got a paper profit, but you haven't realized any profits. From a trading point of view, I like to have a separate equity portfolio or even the single stocks or CFDs, and that's for trading. Receiver says anything as derivatives is classified as income. So that's the easy way to handle that. But we talk about it in the year. What you can do also, really, drop me an email. I'll send you our past webinars. We spoke about the difference between being a trader and being an investor. We did touch on how to manage this. I can send you the emails on that, the past webinars. Carl, you asked the question here, can you move assets between portfolios? Okay, when you're talking about assets, are you talking about different equity portfolios? As long as it doesn't change, the name doesn't change. If you're going from one personal portfolio to another portfolio in your own name, so from Coral to Coral, no problem. But if you're going from Coral into a company, you might be triggering CGT in the form of, not CGT, CGT number one, but also more not so much CGT, more transfer tax, 0.25% transfer tax. So that's something you have to look at. I hope that answers your question. So personal accounts, Coral, you're clarifying it. Yeah, it's a way, there's ways and means of doing it. Obviously, ideally, if it's all accounts with PSG, we can make ways and means of doing that. Okay. Looks like that's all the questions, people. I'm sorry we've gone over time again. I got excited about the topic. Cool. Okay. Okay, that looks like all of it. Okay. Okay, I was going to just close this quickly and just say thank you from my side. I'll be talking to you guys. I think this will be my last webinar for a while. And all the best. We'll talk again. All the best. Bye-bye.